back to this week's market update. Today is Monday, April 13th, 2026, and we'll jump right in. Equities posted a strong week supported by easing geopolitical tensions, slightly better than expected inflationary data, and growing optimism ahead of a potentially really strong earnings season. The rally was led by growth stocks with the Nasdaq Composite up almost 4.7% last week, followed by the S&P up more than 3.5% and the Dow up a little more than 3% last week. Moving into our economic data from the week, we did see inflation rise sharply in the month of March, though the details offered some reassurance. Headline CPI came in at 3.3% annually, up 0.9% in the month, while core CPI, which excludes food and energy prices, rose a much cooler 2.6% and only 0.2% during the month. We'll take a look at some of the categories driving these differences in the next slide. Looking deeper into this month's CPI data, we had, as I mentioned, headline CPI at 3.3%, core inflation, which excludes food and energy, up 2.6% from a year ago, a much cooler inflation rate there. And that was largely due to the jump in energy prices due to the conflict with Iran. Energy prices rose almost 11% in the month, with other categories like energy commodities up more than 21% in a single month. Other categories, however, showed signs of cooling, with food prices actually down 0.2% in the month, up a very modest 1.9% from a year ago. New vehicles up a very slight 0.5%, while used vehicles were actually down 3.2% from a year ago. And then last but not least, shelter was up only 3% from a year ago, so that's continued improvement on that front. The takeaway from this month's data is that current inflationary pressures are seeming to be very concentrated for now and geopolitically driven rather than broad-based, which investors took as a positive sign last week. Other inflationary data we got last week was February's PCE inflation. It showed inflation as broadly stable, with PCE coming in at 2.8%, while core PCE was slightly higher at 3%. Both up 0.4% for the month. While the numbers remain above the Fed's 2% target, the February reading predates the surge in energy prices that followed with the conflict with Iran, as we just saw in the March CPI numbers there. So as those price increases begin to flow through the data, I'm sure next month's PCE reading will be higher. Hopefully the inflation will be very short-lived and contained within a few months as energy prices hopefully settle from a resolving conflict. But just things we want to continue to take a look at as inflation is such a big driver of the US economy. Along with that PCE inflation report, we also got personal income, spending, and savings data for the month of February. It presented a somewhat cautionary signal as personal income actually fell 0.1% during the month, while spending rose 0.5%, a combination that pushed the personal savings rate down to 4%. Now, 1 month does not make a trend, but should this dynamic persist, consumers could find themselves in an increasingly pressured financial position. Alongside those income pressures that we just took a look at from February, we also got the Consumer Sentiment Index from the University of Michigan. It showed that the index fell very sharply in the month of April, plunging 10.7% for the month and down almost 9% from a year ago. The decline was broad-based, with setbacks recorded across all age groups, income levels, and political affiliations, reflecting the widespread nature of geopolitical concerns on households. Within the index, current economic conditions fell the most, down 16.2% from a year ago, while the consumer expectations, the forward-looking index, was down at just 2.5% from a year ago. Year-ahead inflation expectations jumped a full percentage point to 4.8% here. You can see a fairly strong jump there, underscoring rising concerns around inflation. Continuing on into last week's economic news, we had a fourth quarter GDP revised lower from a previous estimate of 0.7% growth to just 0.5% growth in the fourth quarter there. This was due to a slight revision downward in consumer spending as well as investment. Government spending continued to put a drag on it, though it was revised to be slightly better, as well as exports also being revised to be slightly better. Overall, the fourth quarter was largely affected by the government shutdown, which really put a drag on economic growth as government spending does make up such a significant portion of the US economy. We'll have to continue to monitor the data and take a very close look at the first quarter's GDP print when that comes out in a few short weeks here to see how this trend persisted or did not persist into the new year. Last but not least, the ISM Services Index continued to show that the service side of the economy is relatively healthy despite some concerning signs in this month's data. The overall index came in at 54%, so anything above 50 being bullish, anything below 50 being bearish. Still in a very healthy territory there, although we did see a slight monthly decline. The warning sign, though, that we want to take a look at and continue to monitor is that the prices paid index shot up to 70.7, which you can see is a relative high for several years here. While on the other hand, the employment index fell to 45.2. So with this combination of higher prices and weaker labor markets, we want to keep an eye on that as the data goes on in the coming months to see if this was just a 1 month blip or continues to be a trend. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.